You ever open your payslip and feel personally attacked? You worked all month, but when the money finally hits your bank account, it looks smaller than expected. Because before it reaches you, it goes through the tax gauntlet: income tax, national insurance, student loan deductions, pension contributions. And suddenly the government has taken a serious bite out of your salary. Now, here's the strange part. While millions of people are being taxed on their labor, some of the wealthiest people in the UK legally pay almost nothing in tax. Not because they broke the law, not because they hid money in secret islands, but because they're playing a completely different game. Most people are playing checkers, but the ultra-rich? They're playing 3D chess. See, the middle class earns money from work, and work gets heavily taxed. But the wealthy, they build wealth through assets, and assets only get taxed if you choose to sell them. That tiny difference changes everything. Because once you understand the strategy the ultra-rich use, you realize something shocking. The tax system doesn't just reward hard work, it rewards ownership. And the strategy they use has a name. It's called buy, borrow, die. Let's start with the first step, buy. Here's something most people never realize. The ultra-rich are not chasing high salaries. In fact, salaries are the most heavily taxed form of wealth. If you earn more money from your job, you simply move into a higher tax bracket, which means more of your income disappears before you ever see it. But assets play by completely different rules. Instead of chasing salary, wealthy investors buy things that increase in value over time. Stocks, businesses, private equity, or one of the UK's favorite wealth machines, London real estate. Let's say someone buys $5 million worth of assets. Over the next 10 years, those assets grow to $10 million. They've just made $5 million in gains. But here's the key detail. They haven't sold anything, which means no taxable event has occurred. So the tax authority, HMRC, essentially sits on the sidelines. The gain exists on paper, but until the asset is sold, that gain remains untaxed. This is the first big secret of wealth. Rich people don't focus on income, they focus on ownership. Because ownership lets wealth grow quietly in the background without triggering taxes. And once that wealth grows large enough, step 2 begins. At this point, you might be thinking, okay, but how do they actually spend money? If they're not selling assets and they're not taking big salaries, how do they fund their lifestyle? Private jets, luxury homes, art collections? The answer is surprisingly simple. They borrow. More specifically, they use something called portfolio-backed lending, often referred to as a Lombard loan. Here's how it works. Let's say someone owns $20 million in stocks. A private bank looks at that portfolio and says, great, we'll lend you money using your investments as collateral. So the wealthy investor takes out a loan, maybe $2 million. Here's the key part. That $2 million is not income. It's debt, and HMRC does not tax borrowed money. So now they have millions in spendable cash without triggering any capital gains tax. Meanwhile, their investments are still sitting in the background, growing. Let's say the portfolio grows at 8% per year, but the loan interest is 5%. Even after paying interest, their wealth is still growing faster than the cost of borrowing. So they're effectively funding their lifestyle using tax-free loan money while their assets continue compounding. It's like having a money tree that you never cut down. Instead of selling the tree, you borrow against it. But this raises a final question. Eventually, the loans need to be repaid. So what happens then? That's where the final stage comes in, and it's the most controversial one. The final step of the strategy is a little morbid, but incredibly powerful. Die. Here's why. Normally, when you sell an asset, you pay capital gains tax on the profit. If you bought shares for $1 million and sold them for $10 million, that $9 million gain gets taxed. But something unusual happens when assets are passed down through inheritance. In the UK, when someone dies, the cost basis of their assets is reset to the current market value. This is often called a capital gains tax uplift. Let's break it down. Imagine someone bought shares decades ago for $500,000. By the time they pass away, those shares are worth $20 million. That's $19.5 million in gains. Normally, selling those shares would trigger a massive tax bill. But if the assets are inherited, the new starting value becomes $20 million. The decades of gains effectively disappear for tax purposes. They're wiped clean. So the heirs inherit the assets with a fresh cost basis. They can sell a portion to pay off the outstanding loans and still keep the majority of the wealth, all without triggering the huge capital gains tax that might have existed before. In other words, the tax bill that might have accumulated for 40 years gets erased in a single moment. This is why the strategy is called buy, borrow, die. Build wealth through assets, borrow against them instead of selling, and eventually pass them on with the gains reset. Now, here's where the conversation usually gets political. People start debating whether tax rates should be higher, lower, fairer. But that debate often misses the real issue, because the ultra-rich aren't focused on tax rates, they're focused on taxable events. If you never sell your assets, you never realize the gain. And if the gain is never realized, the tax rate becomes irrelevant. This is why wealthy investors don't optimize for income, they optimize for net worth. Income gets taxed, net worth compounds. The middle class is trained to think like this: how can I earn more money this year? But the wealthy ask a different question: how can I own assets that grow for the next 30 years? That shift from income optimization to net worth optimization is the real lesson. Because once you start thinking in terms of ownership, the entire financial game changes. You stop chasing bigger paychecks and you start building assets that work quietly in the background. Assets that grow, assets that compound, assets that eventually give you the same options the wealthy already have. And once you see the system this way, you realize something important. The rules were never hidden. They were just being played by people who understood them better. If you enjoyed this video and want more breakdowns of how money, wealth, and the financial system actually works, make sure you subscribe. Because the rules of money aren't complicated. They're just rarely explained. And on this channel, we explain them.